Deflation is a long-term decline in asset and consumer prices. A sustained decline in demand is what is actually responsible for the widespread deflation. Deflation is also called negative inflation. When the cost of goods and services rises, it is considered inflation, whereas when they fall, it is considered deflation. Advantages of deflation. Here are several ways the benefits of deflation might be stated. Enhanced capacity to spend. If inflation is negative, or deflation occurs, then currency appreciates. As a result, consumers have more money to spend and merchants may reduce their prices. Monthly budget. Since commodity prices decline during deflation, consumers can meet their basic necessities with less money. Thus, it helps those with lower and intermediate incomes by lowering their monthly outlays. The savings rate rises. When prices of things drop and consumers spend less money, deflation sets in and causes them to save more. Elevated average income. Since deflation reduces spending and boosts savings, it aids in maintaining a higher quality of life. Helpful to the debtors. Real debt loads rise as deflation bites. The beneficiaries here are the debt holders. Spend less money on running a business. Deflation reduces the price of doing business by causing a drop in the cost of inputs including raw materials, equipment, technology, and fixed assets. Consequently, it is a good time to invest for the long term. Disadvantages of deflation. We may summarize the major disadvantages of deflation as follows. Lower spending. Some consumers may cut back on spending on high-end items in the hope that their prices may drop even more in the near future. Therefore, deflation may lead to less spending by consumers, which is bad for the economy. Loss for investors. During a period of deflation, the value of stock held by investors and manufacturers is eroded, causing losses for those parties. Boost the worth of debt. Since the value of debt rises in a deflationary economy, it becomes more difficult for current borrowers to pay off their loans. Potential for joblessness. When prices drop, businesses lose money, and as a result, some of them may go out of business altogether. It might lead to an increase in joblessness. Reduced GDP. Reduced economic growth and political unpredictability result from reduced output, decreased consumer spending, rising debt levels, and high unemployment. Types of deflation. Many people view deflation as an economic problem that might make a recession worse or trigger a deep recession. There are two types of deflation discussed below. Strategic deflation. When the country implements a monetary policy to reduce the overconsumption of the population, it causes strategic deflation. In this situation, since the frequency of overconsumption is reduced, it may help prevent the rise of the market price of products. Circulation deflation. This kind develops as a result of a nation's unpredictable economic circumstances. Circulation deflation happens when a stable economy is going through a slowdown during its transition period. Such circumstances will undoubtedly worry the general population. There is also the manufacture of the same commodities in comparable numbers, which is considered excessive. Later on, this can lead to a sharp drop in the cost of goods. What causes deflation? Deflation can occur due to a lot of reasons. A few important reasons are: decreased consumer demand. When the demand for a product falls, it happens either due to high prices or insufficient product supply. This leads a business to take decisions like decreasing the prices or reducing the number of employees. A vicious cycle is caused by deflation. Whenever a business decides to cut down jobs, it causes a further fall in demand leading to more job cuts. With the fall in employment, there is a decline in business demand. Businesses have no option but to reduce prices. Fall in production cost. The production cost goes down whenever the cost of key production input. For example, if cotton prices have decreased, the production cost of garments will eventually fall. Under such a scenario, producers might increase production, causing an oversupply of the products. But if the demand remains unchanged, businesses will need to cut their prices to keep consumers buying their products. Supply of money. If the central bank decides to put strong interest rates in their monetary policies, the people intend to save their money instead of spending it. This causes a reduction in cash circulation in the country. In another scenario, deflation can reach significant levels when the money supply does not rise at the same rate as economic output. For example, a country makes 100 toys a year with a money circulation of $100. However, it now produces 200 toys as a result of economic developments. However, the central bank is unable to create enough money to be spent on the amount of production. As a result, 200 toys represent $100. It causes deflation since each toy now costs $0.5. Fierce competition in the market. Deflation is caused when there is fierce competition in the market among competitors, which causes aggressive competition in the market. This usually leads them to cut down their prices to attract more and more customers to make a place in the market. How does deflation impact an economy? During inflation, people tend to spend less and save more. On the other hand, the stock market faces high fluctuations, which results in strict regulations taken by the government. The investment behavior of investors is affected by this, and they tend to make safe and conservative investments. Favorable investment strategies are either short-term investments or tangible investments. Examples of short-term investments are money market accounts, short-term mutual funds, peer-to-peer lending, and treasury bonds. Deflation refers to a general decrease in the prices of goods and services, usually resulting from a reduction in the money supply and the availability of credit within an economy. Central banks, such as the Bank of Canada or the U.S. Federal Reserve, play a crucial role in regulating the monetary supply and work to control the possibility of deflation, just as they do the possibility of inflation. Though monetary issues are usually the chief cause of deflation, declining prices can also result from an overall drop in the demand for goods and services, reductions in government spending, stock market downturns, increased consumer saving, and higher interest rates. Likewise, deflation can also be caused by technological advances, especially those that increase productivity faster than the supply of circulating money and credit. While the declining price of goods and services might sound attractive, who wouldn't want increasing buying power with the same income? The downsides of deflation can be even more severe than those of inflation. Deflation can drive waves of unemployment, as with price drops come lower profits, forcing companies to lay off workers to cut costs. Deflation also makes debt more expensive, as interest rates trend upwards, causing businesses to curb spending. And as deflation generally occurs as part of an economic contraction or recession, in the very worst cases, a deflationary spiral, a domino effect of lower prices leading to decreased production, leading to lower pay, leading to further lowered prices, and on can turn a recession into a full-blown depression. Deflation has happened before. When deflation hits, it tends to hit hard, as history shows us. Canada has had 9 periods of deflation since 1914. But when they happened, they were devastating. Prices dropped 20% in the early 1920s, and during the depths of the Great Depression from 1930 to 1933, prices fell an additional 25%. Falling prices meant lower profits, lower incomes, and rising unemployment, with the deflationary cycle becoming self-reinforcing. Similarly, the wholesale price index fell 33% in the United States during the Great Depression, while unemployment climbed above 20% between 1929 and 1933. The U.S. economy wouldn't get back on its previous long-term trend until well into 1942. Globally, numerous other countries have been mired in periods of deflation, with Japan perhaps the most famous, or infamous, example. Between 1991 and 2001, Japan experienced its so-called lost decade of stagflation, a vicious combination of economic stagnation and price deflation that sapped Japan's once booming economy as the country struggled with both tight credit and a liquidity trap. While Japan eventually pulled itself out of this period, its recovery was notably slower than other major economies, and the effects of this period still reverberate in the Japanese economy today. What is the current deflation risk to the global economy? Deflation commonly follows periods of prolonged artificial monetary expansion such as most economies experienced during the pandemic. So, what is the current risk of deflation to the global economy? One theory is that the rapid price rises seen in 2022 could turn to deflation in 2023 as global growth slows, energy and food prices fall, and unemployment begins to rise. And there are some signs that this is beginning to happen. In Canada, once-in-a-generation high CPI inflation has dropped to 5.9% in January 2023 from a high of 8.1% in June 2022, with projections that it could go as low as 3% by the end of 2023. In the United States, the CPI fell even more dramatically, from 10.57% in the first half of the year to 1.88% in the second. These U.S. numbers were driven by price drops in 59% of CPI components, including oil, down 38% from 2022 highs, lumber, down 67%, and housing, down 10% from peak values, as well as the biggest decline in annual M2 money supply growth since World War II. Similar evidence is available all over the world. In Turkey, inflation declined at its fastest rate in a quarter century in December. The UK saw price declines in December for the first time in over a year. And in France and Germany, inflation slowed more than expected at the end of 2022. While there are too many metrics at play right now to say definitively that a period of deflation is around the corner, with signs that point to the possibility, investors would be wise to take steps to protect themselves and their portfolios from the chance. Investment ideas for deflationary times. While it might be hard to forecast deflation in advance, it can happen quickly. Remember how fast 9% inflation snuck up on us? So how can investors position themselves to weather a potential period of deflation? Here are a few ideas. High interest savings accounts, HISA. An option that provides both earning potential and security. By having funds in a HISA investment, you gain access to high-interest deposit accounts with major banks that offer higher rates of return than any savings vehicle besides government bonds and treasury bills. Depending on the makeup of your HISA investment, interest accrued each month can be paid out either as additional units of the fund or as cash distributions. Defensive sectors. While some investments can be riskier in deflationary periods, investing in defensive sectors of the economy can be a safer haven during economic uncertainty. Defensive sectors tend to have more stable demand regardless of market conditions. These sectors such as healthcare, rights and materials and mining usually have strong cash flows, lower volatility, and more promising returns. Dividend-paying stocks. These companies regularly pay shareholders a percentage of their net earnings, either in cash or additional stock. Such payments tend to be made quarterly but can be made semi-annually or annually. As with defensive stocks, dividend-paying stocks tend to be established companies with predictable profits, such as in the finance or healthcare sectors. Several Canadian banks, for example, have recently raised their dividends. National Bank of Canada raised their dividend 23% late last year, and Royal Bank of Canada, the Bank of Nova Scotia, and the Bank of Montreal have all raised their dividends since February 28. This marks the second such increase for BMO in recent months, following a 25% dividend hike in late 2022. Investment grade, IG, bonds. Also called high-grade bonds, IG bonds are highly rated by rating agencies, rated at least BAA by Moody's or BBB by S&P and Fitch, because they are believed to have a lower risk of default. These bonds tend to have lower yields than lower-rated bonds, making them a stable, low-volatility vehicle to weather uncertain times and deflationary periods. Deflation refers to a time when prices of products are generally lower, and the value of money is higher. Deflation is of two types, that is strategic deflation and circulation deflation. The causes of deflation are decreased consumer demand, a fall in production cost, an insufficient supply of money and fierce competition in the market. Deflation results in a deflation spiral, higher unemployment, increased debt rates and reduced investment. Thank you for watching this video.